My name's David Ando, and I'm the general partner in Ando Capital Management. One of the most common questions I get is about how to structure an investment fund. Should it be a hedge fund, private equity, a holding company, or an SPV? The reality is the structure matters far less than what you think. People assume that if they just pick the right structure, everything else will fall into place. But that's just not how this works. Structure is a container. It's the engine. A container doesn't create returns, it doesn't manage risk, and it doesn't save a bad strategy. What actually determines outcomes is the underlying economics, the risk profile, and the discipline of deployment. It comes down to what asset are we buying? How does this produce cash flow? What has to go right for this to work? I've seen beautifully structured funds fail even with perfect legal work, sophisticated entities, and complex waterfalls. But none of that matters when the strategy itself is weak. There was too much leverage, too much dependence on market timing, or assumptions that only work in ideal conditions. On the flip side, I've seen very simple structures perform well because the underlying logic made sense. There were clear cash flows, defined downside, and patience in how capital was deployed. The problem is that many managers use structure to compensate for a lack of clarity. They hide behind complexity. They talk about vehicles, jurisdiction, and legal frameworks instead of talking about risk. They focus on legal form instead of economic substance. In our case, we focus on absolute returns. This is a fundamental shift in how funds are operated. We're not asking, how do we outperform the index? But much more basic questions. Where is the cash flow coming from specifically? What risks are being taken to generate it specifically? And how exposed is this strategy to external conditions that we don't control? Interest rates, liquidity cycles, regulation, political risks, market sentiment. If returns only exist in a perfect environment, it's not a real return. So once these questions are answered, the structure becomes quite obvious. At that point, structure becomes a tool, a way to express the strategy efficiently. But if you reverse that process and start with the structure first, you end up with complexity that doesn't add value. You end up with optimizing documents instead of decision making. And complexity, when it comes to investing, is usually where the risk hides. So I think the takeaway is quite simple. Structure should serve strategy, not distract from it. See you soon.